Hey, hi everyone. Let's get started. Thanks again for joining us tonight for our event, Understanding India. My name is Justin Jimenez. I'm the head of macro and investment research at StashAway. And tonight we're very honored to welcome two guests to join in on this deep dive into one of Asia's fastest growing markets. So we have with us Marcus Weyerer, who's the director of ETF Investment Strategy for EMEA at Franklin Templeton, as well as Rashmi Kwatra, the founder and chief investment officer of 16th Street Capital. Before we start, just two bits of housekeeping. First, I'd like to highlight that the information presented here is for educational purposes and shouldn't be taken as financial advice. So please speak with your financial advisor or your StashAway client or wealth advisor for advice that's tailored to your own personal situation. Second, we'll have some time for Q&A at the end of this webinar, so please put in your questions in the Q&A box for those of you who are joining on Zoom, and in the comments section for those of you joining on YouTube Live. And just quickly, in terms of the agenda today, I'll first kick off by sharing a bit about what we do at StashAway. Then I'll pass it on to Marcus, who'll be sharing his views on the rise of India. Next, Rashmi will join us for a chat on India equities, and finally, we'll have a bit of Q&A. So for those of you joining us who might not be familiar with StashAway, we're an investment platform, and our goal is to empower people to build and protect their wealth for the long term. So the core of what we do is making investments simple, intelligent, and cost-effective for you. And we've been doing this for about 8 years now, since 2017. We're headquartered in Singapore, but we also operate in 4 other markets, those being Malaysia, the UAE, Hong Kong, and Thailand, where we're duly licensed by each of these markets' regulators. And on our platform, we offer a number of curated solutions for all of your wealth building needs. So this slide shows there's a selection of those. First off, we believe everyone should have a core investment portfolio to build their long-term wealth. We have our general investment portfolios powered by StashAway, which are global multi-asset portfolios managed by our in-house investment team. We also have portfolios managed by our partners at BlackRock and JP Morgan Asset Management. And you can also choose to build and manage your own portfolios with our flexible portfolio product. We also have shorter-term cash management solutions, as well as thematic portfolios if you want to invest in some secular trends. And for accredited investors in Singapore and professional investors in Hong Kong, we also offer access to private markets. So if you're still figuring out what solution's best for you, we might be known as a robo-advisor, but we have real human beings behind the scenes to help you out. And you can always get in touch with our client experience team if you have any questions. Just very quickly, I'd just like to quickly introduce our flexible portfolios before handing it over to Marcus. So a few years ago, we launched this product with one goal, and that was to give our clients more control over how they build and manage their investments. So you're in the driver's seat. You choose the asset classes, you set the allocations, and you can tweak them whatever you like. So essentially, you can be your own portfolio manager. In our flexible portfolios, we have a curated list of over 70 ETFs across various asset classes, and this is growing. It's easy to customize, and there's no limit to how many changes you can make. And even though it's sort of you're in the driver's seat, we also support you with features like automatic rebalancing to ensure that your target allocations stay on track. Getting started simple, you can build from scratch or start with one of our template portfolios and tweak from there. So this is a great option if you want to express your own views on a particular strategy. For example, if you're bullish on gold or India, for example, or want to develop your exposure to any given sector, sort of bond asset class, you can do that. As for what you can invest in, as I mentioned, we offer a wide range of ETFs, including major indexes like the S&P 500, QQQ, different flavors of bonds, and country-specific ETFs like Japan and India. And with that, I will hand it over to Marcus. Just let me quickly switch the screen.
Thank you very much, Justin. Good evening, everyone, from my side, from London. And we're just waiting for the slides for 1 second. There we go. Perfect. Thank you. Yeah, so my topic today is India, and it is really so. If you know a little bit about Franklin Templeton, we have a long history in emerging markets. We have boots on the ground in various of those economies. So analysts actually, although the vehicle of the ETF is obviously passive, but we still use those insights as well. And really, India is one of the countries, when you think about single countries in emerging markets, that comes up most often recently, alongside China. Obviously, China has been longer embedded in financial markets than that is the case for India, and is a larger economy still. But really, the last few years, it was all about India. And we think that aside from a tactical play, that the country really is in a secular trend, or exploiting secular trends that are going to last for a while to come. And a couple of those, and we really only got 25 minutes for that particular session today. So we could talk hours and hours about India, but I gotta boil it down to the key points. So that's why I go right straight into the next slide, please, where we already have the highlights that we're going to talk about today. So for India, obviously, it is a democracy. Modi has been in power now for over 10 years. There was a massive election last year, and he won that a little bit less decisively than markets had originally anticipated. So he's now in a coalition partner. But to frame this is really to think about that this is under Modi, the government is the most market friendly that India has seen pretty much since its independence. And what he really has achieved in the last 10 years, and we're going to look at a few numbers later, is quite remarkable. But they also have plans. And one of the own goals that Modi and his government have set for themselves is to become a so-called upper middle income economy. And upper middle income economies are really just economies where people, the income and the GDP, so the economy in terms of per capita is at about 4,500. That's a definition just from the World Bank. So there's slightly different definitions, but that's roughly where you gotta think of. And so that's the goal by mid 2030. So that gives us about 10 years roughly. And currently that number, so the GNI, gross national income per capita, or GDP per capita, is about 2,500. So if there are any of you who are quick in math, then if you calculate it in your head quickly, I'm not quick in math. I need a calculator for that, but I do know that that requires us for that period of time about 6 to 7% growth in GDP per capita to reach that number. And just to put that number also in perspective, because it's for now it's just a number, right? That is ambitious because it really requires almost doubling the entire economy, and then plus a little bit more because the population of India is also growing. So that is a massive target. But even that, and I am saying that to just say that then that is not the end. Even that 4,500 is still a modest value if you compare it, for example, to China, which is already at about 12,000. Singapore, obviously, as a developed country, is way above that. And then you have the G7 that they tend to be about $30,000-$40,000, and the US in particular is around 60 to 70,000. So there's a lot of potential, but for now, for the next couple of years, we also as investors, we would like to focus on that number. And that requires a few things to happen in India. And we think that many of them are in place, but it starts really with that circle on the left-hand side. So it's supportive government policy. That's why the elections last year were so important, because it really gave Modi another mandate for another few years to continue the reforms that he's already implemented. So when we think about India, supportive government policy goes into kind of all of those other topics that we look into. But there are infrastructure development. We're going to talk about train tracks later on as just one example how they're building it out. Bridges, airports, and so on and so forth. Technology and digitization, incredibly important for markets, for investors. You may know the Magnificent Seven in the US. We think that the US is obviously leading in this space, but there's many other pockets of opportunities, and India is one of them. I just saw a report the other day, actually. So India is now, in terms of so-called unicorns, is a number 3 in the world. Unicorns, for those who don't know, are defined as companies that are not publicly listed, so you can't buy them on a stock exchange, but that already have a value of $1 billion or above. So we've got the US number 1, clearly number 1. Number 2 is China, again, huge economy. Number 3 is the UK. Number 4 is actually India. And if you look not at the value of those companies, but actually at the number of those companies, that India would be number 3, actually. Quite interestingly, because I think some of you or many of you will be from Singapore. Singapore is at number 5, so doing pretty well there as well on that front. Consumerism, another important mosaic in that picture that we're looking at, just because demographics are growing in India. And I think that is a blessing, because there's not many economies, certainly not many developed economies in the world, where you still have growing demographics. And crucially, also China has reached its peak. They are actually now they have an aging population, not quite as bad as Japan and, for example, Germany originally, but they have seen the peak, so there won't be that much drive from there. And the last point that I also want to point out is free trade agreements. That is an interesting one. Not everyone agrees with it, because India has historically been quite timid in terms of striking free trade agreements. They had some bad experiences where the agreements didn't really do what they were supposed to do. And then they have actually put it on hold since 2019. They haven't struck any trade agreements since 2019, until just a couple of months ago, last year, when they actually did a deal with EFTA, that's the European Free Trade Association, so a huge market for India. And then more recently also with the UK, after years of negotiation. And obviously, they are also talking to the US now, and that is important now. We're talking about Trump tariffs all the time, how that has shaken markets really and economies. So I think free trade agreements is not the thing that will propel India to this number that we see in the middle here, to become a middle income country. But what they can do is, at the margins, they can help it. That's how I would see. So I would see infrastructure development, technology, and consumerism as the key parts, and then free trade agreements is kind of the icing on the cake, if you will. And with that, I'll stay at trade a little bit longer on the next slide, please. Because we have to talk quickly about the US, right? I think we're all a bit weary and tired of hearing about Trump and tariffs almost every day, but it is important. And what you see on the left-hand side here is just a list of various countries, not all of them, obviously, but some of the important ones, where the tariffs you see from April 2nd level, that's when they were originally announced, and now more recently, the newly announced tariffs. And there's many negotiations still ongoing. And one of them is India. And so if you look at the numbers, India and the US are currently negotiating about 20% or lower. That is a change of 6% versus the originally announced tariffs of 26%. And it's far lower than some of the other countries, specifically if you look at the top: Brazil, EU, Canada. Huge markets taken together, bigger than the US economy, actually. They are looking currently at tariffs of 30 to 50%. Still ongoing. We see today in the news that there's good opportunities coming out of the EU, but it is uncertain. And we think that generally India is in a good place in the negotiations here. What is more important, however, is that if you look at the right-hand side, India is not overly dependent on the US or exports in general, for that matter. And that is important when we think about, the whole model of globalization going a little bit backwards. So from free trade towards a bit more of a, protectionist stance. And I think that will serve India quite well in the next couple of years. And if you compare it, so if the blue bar that you see, that is the share of the economy, of the GDP, that is not export. So that is consumption, which we already talked about a little bit, and it is investments. So, investments from the government or from companies into manufacturing, into infrastructure, into bridges, roads, that sort of stuff, trains. And what you can see here quite significantly is that some countries, and we've taken here some emerging market countries, are very dependent on exports, and particularly in the US. So Mexico, for example, almost 40% of the GDP is export-led, and out of those 40%, 30% pretty much is the US. So they are in big trouble if they don't find a good outcome. Then you've got others, Taiwan and Korea. They are very strong in semiconductors, so I would also not be overly worried about them, because even if the tariffs would go sky high for them, the US has an intrinsic, very big interest as well, self-interest, that they still can get those semiconductors. So there would be exemptions probably. And then the comparison between China and India is quite interesting, because we talk a lot about China being in trouble, but if you look at the pure numbers, that's the turquoise bar that shows about 2% of China's GDP are dependent on US trade. About similar number for India. The difference is that in India currently the blue bar is working quite well. We talked about demographics. Consumption is doing really well in India. Also, the investments are doing really well, versus in China, that's quite difficult. Investments are actually retracting currently because they had a real estate boom for several years that is still turning down. And also consumption is not that easy to, really spur consumption if you bought a flat a couple of years ago and that's now only worth 20% of what you paid for. We think that China is on the right track with the policies they've implemented, but just I think this chart should really show that India is in a good place here versus some of its peers. And with that, the next slide, please. And I think after that, we get a little bit more punchy. Now we have a lot of numbers and jargon, so I do apologize for that, but I think later on we're going to get a bit more punchy. But I did want to show this because it also tells us an important story, why India has done so well in the last couple of years, and you will see a chart later on about that. And what you can see here is two lines. One is the blue line, and that is the leverage actually. So you see that the leverage has been gone down over time in India. So the leverage is really how indebted are the companies. And on the other hand, you see the line that is going up. That is the return on equity. And you can see here how that is evolving over time. So return on equity is just how much profit are companies going to make based on what they have invested. And so you can see two things. On the one hand, they're getting more profitable. On the other hand, they're having less debt. Both is great, obviously, for shareholders. And the reasons are not quite clear, but it is notable that they happened particularly since 2020, when we saw a lot of companies taking care of their balance sheets, making sure they're not over leveraged, they don't have too much debt, cutting costs because it was a real shock to the system, obviously. And it has worked, and that also drives valuations up because investors are then generally willing to pay some more for that. And with that, on the next slide, please. This is one of my favorite slides, actually, because it's very obvious. It tells a story. It doesn't show all of that is to India. It's really just two small examples of why we think India is doing so well. But we talked about tech and infrastructure already. So tech, incredibly important, obviously, but it's also related to infrastructure. And these are two charts here. On the left-hand side, you can see the blue bars. Those were the imports of mobile phones. So you could see just 10 years ago, India imported about 200 million, close to 200 million mobile phones each year. And you can see how that number got smaller and smaller over time. And then the turquoise bar are the number of mobile phones that India is exporting. So you can see 10 years ago, pretty much nothing. And then since 2019, it's gone up regularly. The numbers are always a little bit delayed because the numbers are not reported that frequently. But when we get the new numbers for 2024 and then 25, they will look even better. So long story short, 10 years ago, India produced pretty much nothing in terms of mobile phones. Today, it produces 97% of its own mobile phone demands. And we've got 1.4 billion people in India. They produce it locally, and they have some phones left to actually export. And that's quite stunning. That doesn't always mean that it's Indian companies that are producing those phones. It's it can be Apple, it can be Samsung, but they are setting up shop in India to produce. And that's the second part, right? So tech is the mobile phone, but infrastructure that means you have plants where that stuff can get built, and you're attracting investors, the likes of Apple and Samsung and many others. This is just one example for tech. We're also talking about pharmaceutical companies going to India. And that really is driven also by government policy. So there's some subsidies for that, tax breaks, and so on and so forth. And then also you have a lot of well-educated young Indians that can work there. So this is, we think, a long-term theme, not least because of the geopolitical situation also that we have. So a lot of companies, they built up big shops in China, and because of the geopolitical situation, they are now doing what is called China Plus One. So that means they're still in China because they have great infrastructure. They, been doing that for many, many years now, decades actually. But they're also setting up shop in other countries just to be diversified in terms of their supply chain. And India is most often the country of choice here. And the chart on the right-hand side is, in my mind, similarly stunning. So it's a little bit complex. That's why bear with me for a second. I'll go through with you. So we have here the length of the rail tracks, and that really can be an indicator of the overall infrastructure. And don't forget, companies like Apple, when they come to India, they need good infrastructure because you need to get the phones or whatever they build out of the country to airports. You need to have the workers to be able to get conveniently to the locations. You need to have, especially India as a huge country, you need to have different business hubs connected. Finance, still now we're doing it on Zoom, but very much a people's business. So all of that is important, and I think rail tracks are a good indicator of that. And if we look at the very left bar, that's the US, so a G7 country, obviously. That one, you have to look at the right-hand side to see the kilometers of tracks. So the US has about 300,000 kilometers train tracks. Then we got India, 65,000. And then we got a country like Germany, which is arguably smaller than India, but more developed. Germany, when you remember the GDP per capita we talked about, for India, 2,500. Germany is 40,000, 50,000 in that area. So a much richer country, but less connected than India in that measure. France less, Japan less, Italy, UK. Canada, I'm sometimes in Canada. Canada is all about cars, so there's no train. I mean, there's some trains, but there's almost no trains that people take frequently. And if it is, then it's short distance trains. The rest is plane or car. And now I would like you to look a little bit at the blue bars on the right-hand side. So in the decade between 2004 and 2014, that's before Modi came on, India built a total of 15,000 kilometers of rail tracks. So out of those 65,000 now, about 15,000, and some renewals, obviously, and renovations over time, but about 15,000 of that were built 2004 to 2014. Now Modi came on, and you see in the last decade, they've built about double that, so 30,000. And now the goal is, and that's not a decade, that's only 5 years, between 2024 and 2029, the goal is actually to build 40,000 of kilometers of rail tracks. Currently, they're not quite on track for that. they're building about 15 kilometers of rail tracks per day. You can do the math. They're a little bit behind the 40,000. But if you look at how they've developed over 2014 to 2024 and now, they're going to get there. And I think the exact number is not that relevant. What really is just relevant is that India is currently building about 30,000 kilometers of rail tracks a year. That is more than the entire network of France and Japan. And they're aiming for 40,000, which would be the entire country of Germany in terms of rail tracks. So again, just two numbers, right, to give you a feeling about what is really happening in that country. And I would like to go to the next slide. Thank you very much. To already come slowly to a conclusion about why we are excited about India beyond those details that we talked about, right? So we have on the left-hand side supportive government policy, and don't worry, I'm not going to read all of it, and we've discussed a few things, but I want to mention a few. So the budget 2025-2026, that was interesting because it includes tax cuts. Think about consumption. When tax gets cuts, that's usually good for consumption. People got more in their pockets. And then Startup India, I've already mentioned how the startup scene is very vibrant in India. But now we're not only seeing that ingenuity of Indian engineers and the workers there and some companies, but now we also see the capital flowing into India. And that merging together is incredibly powerful. And as I said, you have now India at number 3 in terms of unicorns. And some of those unicorns, they will come to market at some point, and they will be included in an index. And that is obviously a fantastic growth engine. Infrastructure development, I think the slide before told you all of that. I think one thing here to highlight is a new airport, massive, going to be Noida International Airport. That's going to open in September 2025. That is actually in schedule. So let's see, we got a couple of months whether it happens, but we're all optimistic. Some of you, you're not in Europe. My heritage is actually German, and some of you may have heard about the Berlin airport, and you think about German efficiency, but that airport got finished 10 years or even more after it was supposed to open. So India is doing it on time. And it's a massive piece of infrastructure that will add to the productivity in the country. Free trade agreements, we already talked about some that were quite successful, and also some of that they have done in the more recent past. They have been better than the ones they've done, let's say, a decade ago before they put a halt on it, and so that is looking quite positive as well. Technology and digitization, we did talk about it. I mentioned Apple, Samsung, and others. Micron is an important chip manufacturer, the only one actually that is not on par with NVIDIA, but close to them in the memory chip space. So they're not doing really AI, they're doing memory chip, but that's also very much in demand. And then you had a joint venture between PSMC, also a chip manufacturer, and Tata Electronics. And you see just that joint venture alone brings 11 billion of capital into India. And the last part, and maybe one of they're all important, but I think the real opportunity is in consumption in India. And we call it consumerism. That may have a slightly negative connotation, but what we really mean by that is that, so you got to think about India, where still 50 to 60% of people and the economy is actually agriculture. So about half of Indians, at least more than 500 million people, so not quite half, but 500 million people are dependent on agriculture. So you got bad monsoon, climate change, that hurts the country. But with that upskilling that we talked about, education and so on and so forth, and those companies coming in, that is getting less and less important. And so they got better paying jobs. They got more companies coming into the country that pay more. And then so the people have more to actually spend as well. And then now that they're all producing their shiny mobile phones, they may as well also buy Indian stuff. And so we think there's a lot coming together. Favorable demographics. India is one of the few countries that is still growing in terms of population, young population as well. The middle class is growing fast because of the capital coming in. That then means that premiumization is what can happen. So they can buy more expensive stuff, nicer stuff. And already 60% of their GDP is from domestic consumption, actually. So when that engine really starts ramping up, then this will be a key driver for that growth that we need. You remember from the first slide, really the government needs 6 to 7% growth for the next 10 years to really get there. Education is a question mark here because there are many young people as well. I said they're well educated. They are, but there are also many people who are who don't have access to computers in schools, to the internet, and so on and so forth. Very many rural areas. So there's a question mark there. We think the government has that as a high priority, but that's something we as investors look at what's going on in that section because it will be crucial. But for now, we think they're doing it well. And with that, if we go to the next slide, it's not only us who think they're doing it well, but it is incidentally also the markets who think that they have done well. And what you see here is the chart over the last 10 years in India, really. Indian stocks, equities, they have grown about 10% on average. But what you can really see is that since COVID, and you remember we had one slide where we showed that really also during COVID, companies have looked at their business hard and have made changes. We can really see that rally going on. And so that is obviously a result of the government policies, of the factors that we have seen of foreign capital flows into India, and of that strong growth that we've seen at 6% on average. And we really do think, aside external shocks, and aside something in the government that looks very stable, but you can never rule it out. If those things do not happen, then we think that they remain on track for maybe 5.5% in 1 year, 6.5% in another, and then the good year maybe 7%. But on average, we think they're going to reach that 6%. So that means we're very optimistic on India by and large. There are a few question marks. Number one is valuations. So I'm not going to go into much detail now, but India is expensive in terms of certain measures. So for example, price to earnings ratio is interesting one. So how much do you pay for a stock given the earnings of that company? They are high, but they're justified because they have that strong growth. Another one is taxes. So as an investor, you have to pay capital gains taxes. That applies actually to the fund. So not you on an individual level. If you buy the fund, you don't have to pay that. You have to pay in whatever Singapore or wherever you may be domiciled, but the fund actually has to pay those taxes. And so that means that the numbers you see here, that is the index. You're not going to quite make that as a fund investor. That's the bad news. The good news is that there is no way around that. So there's no other structures or anything. So every investor who invests in India has to pay those taxes. It is worth mentioning that some funds display the taxes. So if you look at our ETF, for example, you would see that this line would be under the blue line because of the taxes. And then there is other vehicles that don't display it in the value of the fund, but it's still there. You will have to pay it once you sell out of the fund. So you don't get around the taxes. That's just the two things, right? So you've got high valuations and you have to pay taxes in India plus whatever you have to pay at home. But I think those are the negatives. You cannot get around them. If you want to invest in India, you have to currently accept high valuations and you have to pay the taxes. But FTSE, that we talk about this index here, very broadly diversified. So you get all of those pockets of growth that we talked about, not just one. Disaggregation, we talked a little bit about China. You had another slide with other countries on there, Taiwan and South Korea, for example. So we really see a trend of, not seeing emerging markets as one whole blob that are all the same, because they're not. And we see investors more and more disaggregating their exposures, like having an India slot, like you have now available. And we think that India is a beneficiary of that. But it will be probably worth to keep in mind. There's other countries that may also be of interest at some point. But all those countries, really the core message is they're different. And India, we talked about tariffs, we talked about relocation from China, are in a good place currently. Portfolio diversification, same thing. Tariffs is a good example. There's many other places that are in a bad spot currently with Trump. India, we think, are in a good place, is in a good place. And then we talked about the structural drivers. So that all to say, just because the last 10 years have good and India is expensive does not mean that the next 10 years cannot be good. We think that the market is getting it right. And so far you can see it's a buy the dip market. So whenever it's pulled back, it's also rallied back quite quickly. So we think it's both interesting as a strategic holding, but also obviously as a tactical holding when markets are weaker. We think that as long as none of those big drivers change in the big picture, that usually weekdays or week month in India would be buying opportunities. And with that, I'm actually through my presentation for today, but we're going to have some chat now. Thank you very much.
Great. Thanks so much, Marcus, for that deep dive into India. Right now, I'd like to invite Rashmi to the, I guess, stage, the virtual stage with us for a bit of a fireside chat. Some questions I prepared for you guys on India. Maybe we can start with a round of intros. If maybe Rashmi, would you like to start first?
Sure. Hi, Justin. I run a fund called 16th Street Capital. So we invest in a very concentrated portfolio, so 20 equities in both India and Southeast Asia. So India, Indonesia, Vietnam are our largest market. About 60% of our investments are in India. Companies that have very ethical management teams that are aligned with our long-term interests, that are growing their earnings much faster than inflation, and can do so at incrementally high rates for a very long time to come. So that's what we do.
Great. Thanks for that, Rashmi. Maybe Marcus, I think you jumped in earlier. Maybe you can share a bit about what you do at Franklin Templeton.
Okay, yeah. So Marcus Weyerer. I work at Franklin Templeton in London. And I'm between product on the one hand and research on the other hand. So my hat is ETFs. And what we do, we have about globally 50 billion now assets in ETFs. We've wrote it up about 7 years ago, and this is a big growth market for us. And I'm like the middle person between why a certain product would be relevant in a certain macroeconomic environment. And much of what we talk today, that's kind of my day-to-day business. We have other markets, but that's really my background.
Great. No, thanks for that. Thanks both. Yeah, let's jump into questions, I guess. So maybe why don't we start with the big picture? So Marcus just shared Franklin Templeton's view on India. So Rashmi, I'd love to hear yours as well. So how are you, I guess, seeing the macro environment in India right now? And is there anything in particular that you're keeping an eye on?
I think Marcus did a great job touching upon some of the kind of larger big picture, strong demographics. You still have a young population entering the workforce. That's not true for many parts of the world where, labor is an issue and accommodative policy, public and private. So he touched upon, some of those large issues. We think it's, even short, medium term, a very favorable macro environment for India. Just a few months ago, there was kind of a tight liquidity in the banking and system in India, but now the RBI has turned to become very accommodative. So it's, we have excess reserves and liquidity in the system. Inflation is the lowest it's been in many, many years, almost too low. So we're looking forward to 2% inflation in India is not a good thing. But, it does signal that you're in a low inflation environment, which is great. And then if we can see some demand pick up, and with that, some inflation, that'll be positive for the medium-term growth. So what we're watching out for is this resumption in demand. it could come from both the public and private sector. So the public sector, Marcus mentioned that there was a re-election last year, so it meant that some public capex was a little bit slow to be deployed. But in just the first few months of this fiscal year, they've spent more than 25% of their capex budget already. So we should see that catch up with a lag, and we're hoping that corporate India, which has a lot of cash on their balance sheets, also starts to spend and invest, and that will lead to a great economic growth for the country, as well as low inflation, high reserves, everything really kind of pointing towards a very strong macro balance sheet and growth for the economy.
Oh, great. No, thanks for that. Yeah, we've been keeping an eye on India very closely, actually, on the back of sort of the elections, on the back of sort of the budget earlier this year. There's a lot of great sort of tailwinds coming out of the country on the policy perspective and just in the macro perspective. So that's, I guess, where we are now. Maybe let's look ahead. So, I guess maybe what sectors or themes do you both see driving growth in Indian equities over, say, let's say the next 12 to 24 months? I guess that's part A of my question. Part B, looking even longer term, I guess, what areas do you think are best positioned to benefit from the broader Indian growth story?
Should I start?
Sure, why not? Continue on.
I mean, again, we at 16th Street, we do a lot of research. There's over 3,000 investable companies, even just on the public exchange in India. We scrutinize and do a lot of rigor to pick just 20. And when we do that, we are thinking 20 in our global portfolio, in India about 14. We do that with a multi-year horizon landscape. So I think when you're investing in emerging markets or investing at all, and India especially, I'd like to reiterate kind of a long-term mindset. Multi-years is important. You might not catch it perfectly, but if you have that horizon, we think you'll do very well investing in India and across sectors. So we're invested in consumer consumption, Marcus mentioned, as well as a huge domestic economy, and we see a resumption in consumption demand both in the short term and long term. It continues to be a tailwind for India. The digital infrastructure and just the fact that you can reach so many more Indians today as a private company because of the digital stack is very important. So we're very much invested in technology and the fintech segments, and we also believe India is going to be a huge beneficiary long term of more manufacturing, more industrials, whether it's the roads he mentions, the China Plus One strategy. This is all very beneficial for India. So you can even go into old economy industries and manufacturing sectors for the very long haul.
Yeah, I think there's not too much to add from my side. I would just say, obviously, I'm representing an ETF that has got 200 stocks in it about, so it's very broad, meaning it's broadly diversified across all sectors, and we don't really think that there is particular sectors that you should not hold in India. We do like certain sectors from a macro point of view, but Rashmi mentioned exactly those, right? So it would be consumption for sure. That is maybe the biggest one long-term driver. Another one, and she mentioned also fintech. Generally, we also like banks and the traditional finance sector, just because you've got to, for that growth to happen, you've got to have the lubricant, and that is money. And that's just supplied by the banks. And the private banks in India are in pretty good shape. They've also done their homework. They have good capital ratios, generally speaking. So that should be supportive. And with a growing economy, the finance sector tends to do well. So if I had to pick two standout sectors, that would be that. But again, our ETF doesn't do that. It's a very broadly diversified exposure that really is meant to give you access to the entire economy rather than certain specific bets.
Sure. No, thanks for both of that. For your insights there. So I guess maybe turning to the not as rosy picture. So one of the critiques that you mentioned, Marcus, about Indian equities is that they're relatively expensive. Right now the Nifty 50 is trading at about 20 to 21 times forward earnings relative to about 18 sort of a 10-year average of about 18 times. So Marcus, I think from earlier, it sounds like you think that the fundamentals are justified or those valuations rather are justified by fundamentals and overall growth. If you have any sort of, maybe if you have any addition sort of thoughts around that, and also maybe Rashmi, if you have any thoughts about, whether you think valuations are stretched right now or sort of justified.
Yeah, I mean, from my side, all I can add or should add is they are high, no question. That's why I preempted that question. They're not as high as they have been at parts, right? They were stretching towards 30, so we have come down already a little bit. They're not cheap either. At the same time, I think there's also a few points that are very specific to India that justify the premium beyond the growth that they have. Number one is they have a very healthy retail investor sector. And with retail investors, I don't mean necessarily like in China, for example, they tend to be more day traders and, tactical ones. But in India, you got pension plans and like savings plans that, give some kind of a basis of flows continuously. And then the other thing, obviously, why it's justified is because of that many factors coming together, not just the growth, but the capital inflows of foreigners really, that also just drive that up. So is it expensive? Yes, probably. Is it too expensive? I would say no. And I would look at India as a quality growth exposure. So you got quality, low leverage, those sort of things, high growth, but that usually comes at a price, and that's just that.
Got it. Rashmi, any thoughts on your end?
I think that, people talk of like, very high levels, 20 times PE versus the China market at 10 times PE or X market and not adjusted for growth. So it's important to understand first that, the underlying index in India, almost all the companies put together are growing their earnings, double digit, versus some of these economies where there's much less growth. And then within that, it's, if you can be a little bit more selective, in India, there are many companies that are growing their earnings more than 20%, and can do so for a multi-year horizon. So when you look at a growth adjusted multiple, it's more relevant versus, sometimes we compare just on a, PE basis. And I agree with Marcus that there's been an institutionalization of the retail capital in India, so a systematic investment program institutionalized by the government. I've always believed, we should have more ways to encourage, most investors to invest for the long haul and to do it, without timing the market. And the Indian government has done it in a way that we've seen be extremely effective, encouraging people to, if they make 1,000 rupees or say $100 a month, every month just put $5 and pick which equity mutual fund you want to invest in, but don't change that number of 5 or move it up. And it's been extremely effective because you now have a bunch of real savers in India investing in the equity markets, which means a more lucrative capital markets and a growing and developing capital markets, which is a big indicator of long-term development and growth. And sometimes emerging markets can falter in the development of this kind of institutional base. So for those factors, I think, one shouldn't ignore investing in India, even if headline multiples are high.
Sure. Thanks for that, Rashmi. Maybe quickly on the topic of emerging markets. So Marcus, earlier you mentioned that, investors often oscillate between, China and India when allocating to emerging markets. If you have any thoughts on sort of how, you would navigate that China versus India dynamic today, and, what might shift the balance going forward, and maybe Rashmi on your end as well, maybe in terms of your opportunity set with Southeast Asia versus like India, how do you kind of think through how to allocate to those different regions?
I mean, that's a great question. So what we really notice, and what we also have built our product range around, is that there is more more willingness by institutional investors, as I said before, to go more granular in markets. So I think China has always been seen as a little bit of a, too big maybe to lump together with the others. But traditionally, it has been done. But what we've seen in the last few years has been the rise of so-called ex-China strategies. So emerging markets ex-China, Asia ex-China, for example, where we have a lineup as well. And that, I think, is irrespective of China, whether China is doing well or is doing poorly at any given time. It doesn't mean just because an investor buys an ex-China strategy that they're negative on China. It just means they want to manage China separately from a geopolitical risk perspective. And then you see, I think the next iteration of that is India, that now more and more people are also going direct into India rather than within the big EM thing. I think for that, if you look at our product lineup, that's why we have this very cost-efficient lineup of single countries. Some, like India and China, it's quite interesting. India, we've seen small, still large flows, right? But over the last 3 years, incremental flows almost every day. This fund is now at, I think, 1.7 billion or something. So incremental inflows into India, very few volatility. China, a very, very different picture. Like very little inflows for 2 years, almost nothing. Then big inflows, with the first package that the government issued on support. Then it sold off again. You see people selling out of China again, and then coming back. So India much more stable in terms of investor interest. China not uninteresting, but much more volatile, and you can see that exactly in the market as well. I think that's a great follow-up for Rashmi, because as an active manager, you obviously have to. I don't have to deal with that, luckily, but you have to do that as an active manager. So yeah.
I can keep it short in terms of we've chosen economies where we think there's already a structural underlying growth. So when you have, GDP growth rates of 6, 7, 8%, and, Marcus mentioned GDP going per capita, going from 2,000 to 5,000. These, time and tested, the consumer has more to spend and purchasing power increases. There's, the target addressable market for companies to be profitable and earn from consumers and the government is much, much higher. So by picking markets like India, Indonesia, and Vietnam, we are picking economies where the structural layer is already there, and then our work allows us to pick between that to ensure that we have long-term high returns.
Oh, great. Thanks both for those insights. Maybe let's talk about currency. So, the rupee, a lot of people have focused on the USD so far this year. The rupee from last year, that was around 84 to the dollar. That's gone up to about 86 on average this year and hasn't really come back down even as the dollar has sort of weakened in recent months. Do either of you sort of have a view on the rupee over the next maybe 12 to 24 months? And maybe also could you just talk through how you factor in rupee movements into return expectations for overseas investors in Singapore, in Europe, and the US? I'll let whoever wants to start.
I'll leave it to Rashmi because I don't have a firm view. I can say something, but I'd like to hear.
We don't expect significant rupee depreciation or appreciation in the next, say, 12 months. If you can ever, the currencies and macroeconomic policy, there are many caveats, if and buts, but the way we see kind of the strength of the Indian foreign reserves and the ability to withstand any shocks, as well as how we're seeing trade flows and different geopolitical considerations, we think we're in a much more stable rupee environment. Over the last decade, rupee depreciation against the dollar has been a huge headwind for dollar-denominated funds like ours, and we think there's actually reasons to believe that in the next few years, in the next 10 years, the drag will be much smaller.
Yeah,
Yeah,
no,
so
great.
as I said, from my side, we don't have a particular view on the rupee or any exchange rate for that matter. What I would say is that historically, yes, it has been a drag. I think it's about to the tune of about 3% per year, depending what time frame you look at. I think Rashmi, correct me if I'm wrong, but I think that is the number roughly. So, and then the number that I showed you before, even just purely in the index, right? That was already a dollar number, so 10% already in the dollar. So that's what's been in the past. So you've earned 10% each year on the dollar, even though you had a headwind of 3% per year from the rupee. Other than that, I would also only just highlight, the low inflation environment that we have in India, the moving away from an agricultural economy to more institutionalized sectors that should all work, to keep inflation down over the long term, and that then should help generally the rupee. But where it's fairly valued, I don't know.
Yeah, no. As you said, a lot can happen in currency markets that might not be driven by, it could be driven by this one month, that the next. So that's definitely one of the toughest, factors to forecast, right? Maybe let's move on to a really quick fire section to sort of round up before maybe sort of going into some Q&A from some of our attendees tonight. Just, I'll sort of ask the question just in, 1 or 2 words, even a sentence, sort of your thoughts. So first question, are there any under the radar sectors that you're super excited about?
We're invested in a Ayurvedic company that I'm very excited about. So alternative wellness, preventative health. It's moving as well from a very unorganized sector to much more organized.
I have to disappoint you, unfortunately, because as an ETF person, I mean, we look at companies, but I would not be, I think I wouldn't even be compliant if I said something here, but we really would go, if at all, at sectors, but I think I'll leave it at that if that's okay.
No, I totally understand. Yeah, no, I think, that maybe that is less applicable on your end, Marcus. And maybe this next question is also less applicable. So maybe Rashmi, on the flip side of things, are there any sectors that you think are overhyped at the moment?
I think in every sector you're gonna have some froth, and you just pick wisely. Nothing comes to mind as a overall sector that one should avoid.
No, that's fair. That's fair. Finally, what do you think is the biggest risk to Indian equities right now?
I would say I'm not sure I see, a huge drawdown or major short-term, risks. But there is a lot of cash on the sidelines. The mutual funds we talk about, they're getting flows, but they're still holding on to some cash. So I think there's, people are waiting for a clear signal in consumption before deploying. So hopefully we get that so that, it's maybe the downside, I think, is risks is low, but when kind of the momentum returns will be dependent on some of that. Another thing kind of on the policy side is India sometimes overreaches when it comes to, it tries to toggle between a free market economy and its instinct to protect retail investors, which we think, is wonderful, but sometimes it causes a back and forth in terms of regulation that can cause uncertainty, and market participants don't like uncertainty.
Yeah, so I mean, similarly, I don't see anything imminent. But I would be so what would we look at from a macro point is, I think, 2 main things. Number one, as I said, education. Like, from a very long-term point of view, right? Is the government getting the policies right to deal with those issues that are there? And then the second thing is the infrastructure build out. They have the incentives in place that is working well. The capital is flowing in, but you've got to monitor the progress there, because foreign capital inflows also depend on that progress. So it's kind of, two sides of the coin. Infrastructure gets built out if there's money, but also money comes in when the infrastructure is getting better. And so that, you've got to look at corruption and really see on the quality of the implementation of the policies that need to be monitored. But again, so far, it's been a relatively, I don't want to say smooth ride, but it's been going in the right direction.
Sure. No, great. Thanks both for that. Maybe we could, I know we're a little bit over time, maybe we could sort of just get one or two questions from the audience that they prepared for you. There's one question. So, India has, from Deepak, India has had a long history of protectionist policies, he says. How do you think that, affects your thoughts about investing in the Indian economy over the longer run?
I mean, I go very quick. I think I've had it one slide where I did say, right, there are free trade agreements that is going in the right direction. This government in particular, which is stable, has shown relatively open-mindedness, at least. I would say relative because it's still India, but I think it's going in the right direction. Similar thing, want to keep an eye on it. But again, India already 60% is consumption, so I wouldn't be too worried about it.
Yeah, I think, we know the downside of protectionist policies, but on the flip side, it's also cultivating industry, homegrown industry. And, globally, the debate between, how much to rely on globalization versus self-sufficiency is becoming more at the front, flow. And I think India is an economy that also has not allowed industries to run away because of foreign investment, and in a way is now cultivating kind of homegrown industries, manufacturing, which could be also positive in this context.
Got it. Maybe one last question. I think this is probably more so directed to Marcus. It's sort of related to sort of investing in an Indian ETF. How do you think about sort of like tracking tracking the index when investing in an Indian ETF? And do you think that taxes? How do you think about sort of taxes adversely impacting performance versus index in particular? That's from Jane from
Right. So, I mean, great question. I alluded to it very quickly, right? As a foreign investor, you cannot get around the CGT capital gains tax in India. So the fund has to pay it one way or another. It will create tracking error versus the index. Most likely it will underperform it, especially in up markets, which we all expect and want. And so that is just something you gotta live with it. What is important though is there is nuances in showing that tracking. So it gets a little bit technical here, but I'll keep it short for now. But you can, like we do it, for example, we show pretty much every day, we take the taxes out of the fund price that we show you. So you see, if you look at the screen and you see a number, that's pretty much the number you get if you sell. Now, there's other ways to do it. We do that for openness, but it's not a regulatory thing that you have to do it. You can also leave it in the NAV, net asset value. So you can leave it in the price. So you may, as an investor, look at the price and you see a price and you sell it, but at sale, the broker then deducts the tax. This is not a personal tax to you, but it's on a fund level. So whatever is the estimate for the fund will then be taken out. Different ways to look at it. Does it make a difference at the end of the day? Probably not, because you have to pay it anyway. We think it's good, and that's why we do it that way, to have the clarity and the transparency. But it is something you have to live with. I would say one thing before I finish off, though. We have seen a tax hike in not the last budget, but the second to last budget of that CGT. And you can look at it as an investor, you can say that's negative because now I got to pay more tax. I don't want that. You can also look at it and say, well, but that helps India with the deficit that keeps inflation down. So an investor, I pay more taxes, but maybe my return is also going to be better because it just helps the country as a whole. So long story short, we've got to pay it, to be transparent about it and clear. That's important.
Great. And maybe let's end it there. Just wanted to say thank you so much, Marcus, and thank you so much, Rashmi, for lending your valuable insights and deep expertise and time this evening. And thanks also to everyone for joining us as well. If any of you have any further questions or want to learn more, please feel free to reach out to our client experience team, and they'll get back to you. Yeah, thanks again, and good night, everyone.
Thank you. Good night.
Thank you very much, everyone. Bye-bye.